Hey guys, what's up? Alec back with the daily stock market, and look at that. We have Docusign down 42% in one trading day, which is a behemoth of a move. How often do you see some stocks down trading down 42% in one day? And it's not like this is a penny stock. We're talking about Docusign, which is a pretty large company overall, and they're down 52%, 56% in the last 3 months. We have a lot of different companies that stocks have been devastated over the past few weeks. So we're going to be going over a list of different stocks, 3 to 5 different stocks in this video that have absolutely been obliterated. So strap in because this is one that you're not going to want to miss. Now, you might think that Docusign have missed their earnings very substantially and they're in the negative. They're not even a profitable company, but you are mistaken. They are a profitable company and they actually beat earnings expectations by about 10 cents, and they've been beating analyst expectations on EPS for the last 5 quarters consecutively. So let's dive into it. Why is Docusign stock down 40% in one day then? So here we actually saw a shedding $20 billion of market cap in just one day. Wow. So we see Docusign emerge as hot pandemic stock player last year as a benefit from the needed for the digital contract tools, but the company lost 40% of its value after suggesting the pandemic introduced demand boom is waning. So here we'll see Docusign shares plunge 42% after company gave weak guidance. Shares of e-signature software maker Docusign fell 42% Friday. The company reported guidance on the fourth quarter on Thursday and fell short of the analyst expectations or estimates. This was for guidance, but still Docusign beat analyst expectations for the third quarter, which is important. Several firms, including JPM, Piper Sanders, UBS, Wedbush, lowered their ratings on the stocks following the earnings report, while Citi analyst Tyler Reddick maintained his buy rating and cut his price target from $389 a share all the way down to $231 per share, calling the report one of the biggest software whiffs in recent memory. The pandemic tailwinds came to a much faster than expected halt for Docusign, catching the company off guard. JPM analyst wrote in notes. CEO Dan Springer said in an interview Friday that the primary reason for the slowed growth was the company's execution rather than the macro forces. Now here we have Docusign's revenue pulled up, and they are revenue monsters, growing 50, 30%, 38%, 49% every year consistently for the last 5 years. All right, so if they continue up their growing pace, remember they showed weak guidance moving forward, so maybe they're implying that they can't keep this pace growing any further, which is why they probably took a huge fall. All right, their net income is becoming less profitable. And if we scroll down to their balance sheet, it looks pretty unattractive with their liabilities basically lining up directly with their assets, which is definitely a concern. So the only thing they really have going on for them is generating huge revenues, but they have to start moving that more into profits. Now, analysts have a $170 price target minimum in the next 12 months, about a $212 price target on average. So you can expect around a 50% upside over the next 12 months on Docusign, which isn't huge growth. But we have Brian Schwartz, a top investor from Oppenheimer, top 25 investor, with a price target of $250 in the next 12 months. And this was reiterated just 3 days ago. We have other 5-star analysts coming in as top 307. Patrick Walravens reiterated this 3 days ago. We have some downgrades coming 3 days ago, $200 hold, $200 hold. So a lot of the analysts that are reiterating just 3 days ago, they have at least above 150, and most of them have above a $200 price target for Docusign over the next 12 months. So the best thing to do with something like Docusign currently is probably to dollar cost average in. This is going to be a long-term stock, so if you're not a long-term trader, probably stay away from Docusign. There could be a little bit of short-term potential with the huge fall they had back up to like 175 or 180 in that ballpark. But, you know, it's a very risky stock right now to be jumping in to if you're trying to put like thousands and thousands of dollars in, you might want to reconsider that and look a little bit deeper yourself. Personally, I bought around 3 to 4 shares. I'm going to sit on that, dollar cost average in, see if it can go a little bit lower. And if it goes below $100 per share, that's probably when I'll start buying a little bit heavier on Docusign. Keep in mind, we can also see a huge buy the dippers come in and start buying the dip. We see the volume up to 76 million. All right, today's volume. So that's something to definitely watch out for. It definitely could bounce back if we see a bunch of buy the dippers come and just swallow up a bunch of shares and it recovers 20%, 30% in one day or even 1 week is definitely possible to see for Docusign. Now, after that, we have Alibaba down 8% in just one day, 34% in the last month, and it's been devastated at new all-time lows, yearly lows, I should say, down 58% in the past year, almost down 60%. And this is you could pick this one up in 2017, basically for the same price that it is today. All right, Alibaba is a great company, so we're going to dive in and we're going to compare something like Alibaba against something like Amazon. All right, Amazon, one of my favorite stocks in the stock market, a $1.7 trillion market cap. All right, so it's a really big company. Forward PE of 82. Keep in mind also. But let's go over and see the financial details here and look what we have going on. We have net income is growing significantly every single year. We have total revenues up 20 to 30% every single year. And we have total revenue in 2020 at 386 billion. All right, so remember that number. So this is Amazon we're talking about first, and we're going to be comparing this. This is a $1.7 trillion price tag on this company. We also have a balance sheet. We have a 70% assets to liabilities, which is pretty high as well. All right, so now if we pull up Baba, we see that this company, the market cap, is around 5 times smaller than Amazon. So remember, it's 5 times smaller. The forward PE is also only 13, keep in mind. So it's about 5 times more affordable and as much of a better deal if you take PEs into consideration. All right, so if we look at the financial details, we see the net income is increasing as well. And we see that then 2021, we actually have $100 billion in revenue. Remember, Amazon's doing $300 billion in revenue, and they're 5 times to 6 times the size of Baba. Baba's doing $100 billion in revenue, and they only have 35% assets to liabilities. So if anything goes wrong with Alibaba, they can easily bail themselves out. They have so many assets on the table and so much cash on the table. Very cash-heavy company. So, and then if we go to net income too, they have a $20 billion net income. So that means they're making profit. Baba is making $20 billion of profit per year. And if we go back to the income and we look at Amazon, we have Amazon pulled up again. Amazon did 11 billion in profit or net income and 21 billion in 2020. So Baba is literally making as much profit, as much money as Amazon. All right, keep that in mind. All right, the total revenue that Amazon is bringing in is a lot higher, but remember, they are 5 times the size of Baba. So Baba, in my opinion, is grossly underestimated, extremely grossly underestimated. And the only reason why it's an $111 stock currently at the price is because the FUDs with the delistings, DD got delisted. So there's a lot of fear, uncertainty, and doubt that Baba is going to get unlisted next. And with all that FUD, remember the stock market is like a toddler and it overreacts extremely with bad news and good news. So that being said, Baba's pushed down to $111 stock. If there was no FUD and people actually cared about fundamentals, we should see Baba at a fair valuation of $250 per share all the way to $350 per share based off the fundamentals, their net income, their balance sheet, and their revenue that they're providing also. They have a phenomenal balance sheets. They're one of the most fundamentally sound companies in the whole stock market. Okay, they're just being tortured right now, down 58%. It's basically like, imagine if Amazon was down 58% in the past year. Would you be buying it? So that's kind of the question you have to ask yourself. But the main thing you want to do is be buying. If you are buying Baba, let me tell you, you want to be buying for long term. You want to have a 2, 3, 4, 5 year mindset. You definitely don't want to be buying for short term. And if it goes down further in a month or 2 months and you're saying, oh, why did I buy Baba? I've been holding this for a month or 2 months and haven't made any money. That's the wrong mindset to be buying Baba with. You definitely want a longer term mindset with this stock. And where do analysts have this in the next 12 months? With an 89% upside in just the 12 months to around a $212 stock price. All right, I think it should be higher than that, but hopefully it will at least recover to $212 in the next 12 months. Nothing's guaranteed, and with the FUD around China and the Chinese listed companies on the New York Stock Exchange, it obviously could get worse in future years. There's no guarantee it's just going to be better from here on out, but I think Baba is pretty much bottomed out at this point. I don't know how much lower it can go with a company with great fundamentals like we have Baba, and even the analysts agree. A lot of these guys reiterated this 8 days ago, 12 days ago. We want to see some more recent reiterates. So anything under $125 per share, I'm definitely scooping up for long term and adding to my long term accounts. And the last stock that we have to talk about is SoFi, down 8% on the day, 17% on the week, and 33% in the last month. We timed this one pretty well. We saw the supports in the past above $20 per share. We thought $22, $21 per share was a great place to start selling, and we sold above $20 per share and bought below $15 per share. So for swing traders, there's definitely a swing trade opportunity again. If you can buy below $15 per share and sell above $20 per share, you're going to be looking at around 50% increase on a swing trade on SoFi. And I think SoFi is a great company to do a swing trade on, because that brings me to my next point. They're also a great long-term hold. All right, so worst case scenario, and you have to hold a little bit longer than expected, I think SoFi Technologies is a company that should be worth around $25 to $30 in the future. Personally, I own $1,600 of SoFi, about 100 shares, and we have an average cost of $16 per share. I'm looking to probably double or triple my position under $15 and closer to $14 per share, because I do like SoFi a lot. The market cap is only $12 billion. SoFi shares have fallen heavily from the recent highs as fintech stocks get hit by end of the year volatility. The company is flush with cash from a recent convertible note issue and is likely to partly deploy this during its next fiscal year. I've used the recent share price weakness to add to my position, an action that will stagger over December. SoFi has not been separated from the fintech bloodbath over the last few weeks. The late 2021 fintech and small market cap, from massive fears over the new COVID-19 variant and potential to evade the current crop of vaccines, to hawkish comments from the Federal Reserve and end of the year tax loss harvesting. The collapse of small growth cap stocks over the last 4 weeks have been nothing short of dramatic, and end of the year implosion of over-leveraged stock portfolios, which now find themselves consistently hitting new lows. Against such relenting selling, and battling SoFi longs have been asking where the floor is. Indeed, the collapse has pushed fintech stalwarts, a list that reads like the who's of America's fintech powers, from PayPal, Square, and Upstart, as you can see, with huge losses here. So purple SoFi, orange PayPal, blue Upstart, green Square, and you can kind of see the losses that they've had over the last few weeks. However, the long-term thesis does remain intact, as mass cannibalization of traditional finance by better positioned fintech companies looks set to play out fully over the next decade. Nothing great plays out in a straight line, as this volatility is the price of alpha. Why I am once again backing up the truck. I bought my cash secured puts earlier in November. A weirdly ominous move on the sale happened above $20 mark. I'll use the proceeds together with further cash injections to triple my position in the company. SoFi forms a core portfolio holding as elements from its incredibly bullish story play out over the next decade. The recent volatility from inflation and virus fears will likely to continue to persist near-term headwinds. The market has been extremely jittery over the prospect of an earlier than expected Fed tapering. So be extremely careful for that and be on the lookout for the Fed tapering and the Fed raising interest rates. That's all that means is watch out for interest rates on real estate and borrowing money go higher because right now the interest rates to buy real estate and buy your home are as low as they pretty much have ever been. So as soon as they start raising that, people could start freaking out. I am now fully committed to SoFi's long-term investment story, so I once again back up the truck. Shares of SoFi are back in the buy the drop situation. In the last 18 trading days, SoFi finished green only 3 times. SoFi's members and revenue growth is now deeply discounted. SoFi, a bank in your pocket for all your financial needs. It is hard to decide whether to invest in my money these days because the correction of growth stocks is creating a more bargains than I could possibly buy. I have already bought PayPal because it's revenue growth and Venmo / Amazon partnership, which we went over also in one of my last videos. Alibaba because it's cheap e-commerce growth, which we talked about in this video, and Palantir, which we'll be talking about in a future video as well, because the large and expanding government business, and now SoFi. SoFi experiences rapid member and revenue growth because of its firm's easy to use personal finance app and roll out of its financial products in segments like cryptocurrencies, credit cards, and investing services. SoFi is a bank in your pocket, offering everything you need from home loans to student loans, refinancing, and insurance products to protect your family. So it's all in one, way better than Lemonade, in my personal opinion. Lemonade only does, insurance. This does everything, all right? Student loans, home loans, refinancing, insurance products. SoFi products offering have greatly expanded during the pandemic, and the digital bank offered 4.3 million different products to its members based in its September quarter, showing the increase of 108% year over year. So can they continue the growth is the question. The majority of such offerings relate to financial services, which serve a customer base that has shown appetite for the new investment products like fractional investing or digital currencies. Okay, so SoFi's growth is undervalued. Because of the ongoing ramp in customer acquisition and revenue momentum, I believe that SoFi's drop in price is creating a unique opportunity to buy this undervalued growth stock. In the last 18 trading days, SoFi traded down 15 days. The drop in price occurred chiefly because of the set of the macro factors is weighing on the market, including Omicron variant concerns, high inflation, a supply chain crisis, and still has not been solved. Okay, so there's a lot of stuff going on. That's why we're seeing the dip at a broader sense of the stock market too. Commercially speaking, SoFi will face tougher competition from fintechs and banks in the future that will do everything they can to resist SoFi's disruptive digital bank model. SoFi's personal finance platform itself has no moat, however, which means rivals can build similar digital banking and compete on aggressively low margins. So the final thoughts are shares of SoFi have dropped very steeply since November. Although the firm's third quarter showed commercial success regarding customer acquisition and product growth, SoFi has also raised its forecast for fiscal year 2021 revenues because of the 34% drop in price since November. SoFi's revenue and member growth is now heavily discounted again. SoFi, next to PayPal, Alibaba, and Palantir, is a stock I'm buying during this year-end sale. So if you watch this far into the video, you not only got SoFi, but you also got the few other ones on the list: PayPal, Alibaba, Palantir. So I hope you did appreciate that video. Personally, I am loading up on SoFi myself for my long-term accounts and my swing trade accounts. So I think for every type of investor, SoFi is a great pick right now. And don't forget, if you want cryptocurrency updates, follow the daily cryptocurrency. I post all my updates there. I'm also going to be posting the winner of the giveaway on the NFT giveaway on the video today on the daily cryptocurrency. So check that video out. I post full length 10-minute, 8-minute, 6-minute, 15-minute videos all the time on the daily cryptocurrency. It's youtube.com/the daily cryptocurrency, or follow me at the daily cryptocurrency on Instagram. And I link all my videos on my story as well. If you want to be a part of my close friends list with the stock market program, let me know. DM me. I have a few spots available. I'm going to be raising the price soon as well, just because the demand that we have going into the end of the year. Everyone wants to start the stock market at the new year. Everyone is setting goals for 2022, and right now is a great time to buy the dip. So it's one of the best times to join my program to see exactly what I'm buying during the dip and loading up with my portfolio. All right, guys, you're going to share this video with a friend if you think they'll find it helpful. Also, subscribe with the bell icon on YouTube, and I'll see you guys in the next video. Remember, don't time the market, buy the market. Peace.